Now there's a variety of ways to determine whether you should buy or sell, and primarily we let the market tell us this. There's a number of calculations you can do both during the day and after the day is over, and I've outlined a number of them in the trading manual. But basically, you want to know, is the market overbought or oversold? In other words, where's the trend? Which way should it go? Are we in a market that's just going up day after day? Are we in a market that's up today and down tomorrow? Is it a choppy market or what? And I have some calculations in the manual that show you the overbought, oversold percentage. One of the calculations you'll see is the high minus the open plus the close minus the low divided by twice the range is the overbought, oversold indicator. The general rule, and remember this is just a very general way to identify the next day's trend, is that when that overbought and oversold percentage is under 30, you want to buy, and when it's over 70, you want to sell. Now remember what I said about Taylor's 3-day cycle. You've got the buy day with the low made first early in the day, and it sells up and it closes near the high. Well, if you did this calculation on that day, you would have a high percentage, over 70%, especially if it opened right at the low and closed right at the high. More often than not, it won't. It'll be a little off the low and a little off the high. But what that tells me is it's getting set up based on the 3-day cycle to sell off. And that gives me a slightly bearish outlook on the next day so that I can come in thinking, you know, I have a scenario in mind. And remember, this is not set in cement. It's just, this is what I think may happen. I think it may open higher, go a little bit higher, and sell off. Now, why would it do that? Well, there's still buying left from yesterday. There's still short sellers that went overnight from yesterday who are going to have to buy it up there at a loss if it goes any higher, because overnight their brokers called them and said, you know, you either got to give me more margin or you got to get out of this. And to get out, they got to buy. In addition to that, remember what I said about the stops. There's stops over there above the market. There's stops to buy it up there from the short sellers who are losing. So what's the scenario say? If it goes up there, some buying should enter and temporarily at least drive it higher. And what did I say about the paradox to the market? It goes up to go down. This is what Taylor said. This is precisely what I think may happen. So you got to see how it behaves after it opens. And remember, it won't stay up there for long if it's indeed coming down. And there again, you have a whole nother situation, which is it goes up, you sell it, time passes. Now, I'm timing all my trades because I don't want to be in there for a long period of time when it isn't working, because it means there's something wrong. I know what should happen. What should happen is it should sell off. But if it goes up and you sell it and it goes sideways or it starts to go higher, it's bad. At that point, you got to turn around and buy the highs of the day and let it take off. So day trading requires this kind of flexibility, knowing scenario A says this should happen, but if it doesn't, scenario B will kick in, and at that point I got to change my whole theory about how I'm going to trade. And the overbought, oversold, essentially, and I've got the calculations in the workbook here, tells you briefly, it gives you a point of view on the market. And LSS does this too. It comes in every day saying, today is a buy day, today is a sell day, today is what's called a pass day or a stand-aside day. That means it can't make up its mind whether it's bullish or bearish the next day. Sideways days, where there's very little movement in the direction of prices and it's just up and down and closes in the middle, is a typical day where the next day as well will be a pass day. So you want something to judge it on. If it gets out of line, you see, it tends to get back into line. And you see this a lot. There's this value area in the middle, and the high is made quickly at the top and the low is made quickly at the bottom, and everything goes back to the middle. Now, we mentioned the notion of the market being taken up to come down, being taken down to go up. And this is an important thing to remember because you got to identify when the move is over when you're day trading. And one way to do it is to take the range, the average 10-day range, and multiply it by 150%, and then take the low and add it to that if it's going up, or take the high and subtract it. That's the reason for that is you'll get an extreme big day and you'll make most of your money on that day. As a rule, day trading, you can't make the same amount every day, nor should you try to. If you're going to settle for a fixed profit every day, you're making a big mistake. The reason is the market has big days, it has quiet days. It's been my experience that on a minority of the days you make all the money to speak of. In other words, if there's 5 trading days a week, you may make money on Monday, lose the same amount on Tuesday, make money on Wednesday, lose the same amount on Thursday, and then have a big day on Friday. The Monday through Thursday trades were a wash. What you made, you lost. You had 0 going into Friday. Friday you have a big day. It could be $1,000, $2,000, even $3,000. You do that 4 times a month, and you have a great income day trading. So it's that big day where a lot of the profits come, and that's what you want to do. Now, I'm not saying you shouldn't try to make money every day. You should, but it's not always easy. You can't always prevent the day from turning into a losing day. And I had somebody not long ago ask me, he mentioned to me, we were talking about losses, and he said, "You mean you still have losing days?" I said, "Of course I do. Everybody does who trades futures." So don't think the fact that you have losses means you're a bad trader or there's something wrong with you. It's not an ego thing. Losses are just a part of trading. It's a process. So you come in every day, you do the best you can. You either make or lose money, and you move on to the next day, and you forget what happened yesterday, except if you made any serious mistakes, and then you take them to heart and say, "I'm not going to do that anymore." There are different ways to identify when you have reversals and when the move is over, and you want to be able to identify those things. One of the ways to do it is to look for intraday highs and lows, and even interday highs and lows. In other words, where was yesterday's high, where was yesterday's low? Where was the early high today, where was the early low? These are all key prices, and the reason is that's where brokers all over the country are telling their clients to place their stops. What happens is the stop is like a red flag is to a bull. The market has to get there and get the stops and then pull back, and that's where it will often go. And that's not a good scenario for the people placing the stops. I understand that, but that's frankly how the market operates. They will go and get whatever stops they can get and then pull back. So to capitalize on that, what you want to do is identify where the stop should be and then trade into those stops or fade the running of the stops, trade against it, in other words, and often you'll find that it's a very profitable strategy.